All right, well, good evening, investors. Welcome to our second of our three-part series on getting a start in investing. My name is Mark Robertson. I'm joined here by my colleague, Ken Kavula. We'll show a little bit more details about the two of us in a second, just in a brief look. But our mission here tonight is basically to take a step back and describe, how do you decide when a company is attractive and on sale, the theme being better companies at better prices, and how do we look at that? And that's kind of where we're going to go. Ken, what would you like to add?
Nothing much, Mark. Let's get underway, okay?
Okay. Here's our reminder that we will be talking about companies, showing you information from companies. No investment recommendation whatsoever is intended. Everything that we do, and we do a lot of this, is about a demonstration or an illustration of the methods and techniques and philosophies of the modern investment club movement when it comes to the analysis, discovery of common stocks, and how they fit in portfolios that are designed and managed. You're going to hear opinions from us. Please do your own homework before making any investment decision. If we own something that we're talking about, we'll try to remember to disclose that we do. But again, we're going to be talking about a number of different resources. We assume that you're smart enough to form your own opinions about what is cost effective and an effective tool for you in your investing quest. We're not the boss of you, so that's up to you. If you'd like a copy of the slides of any of these sessions, please send an email to markr@manifestinvesting.com or kkabula1@comcast.net. He just sends your messages to me, and then I forward them on to you. So you might save a step in the process. Just send them to markr@manifestinvesting.com. There you go. All right.
I do answer questions, Mark, okay?
He does answer questions. Again, just we're not gonna spend a lot of time on this. So here's the two of us and our, as I said earlier, uh, significantly better other halves. And again, we've been doing work with investment clubs and individual investors since the early 1990s, and we just love doing it. Ken has been a volunteer since 1995. He's won, I think, every award that the association gives out. So he's got them all. And I worked on the staff and have been very active in a number of capacities on behalf of the organization. We are both volunteers for the Better Investing Mid-Michigan chapter. Anything you'd like to add, sir?
No, except those are nice pictures of all four of us, Mark, especially and our friend Mr. Bucky down there. I appreciate the opportunity to we're going back to the mountains this spring, and I just read there's a big, huge one, the largest one in existence, opened in Pigeon Forge, Tennessee. So I'm going to introduce my wife to Bucky's, and we're going to have brisket sandwiches, okay?
Well, we stopped in one on the way down here to Florida, and Wendy was absolutely flabbergasted at 120 gasoline pumps at the station, and you could not walk inside the store. I mean, it was literally shoulder to shoulder in this in their convenience mart or whatever you want to call it. It's like a mini Costco. Anyhow, onward with the show. Here we covered this earlier in our first session, but just wanted to reinforce that we are talking about different tools. Manifest Investing is a subscription service. It was born out of the work that I did with the Modern Investment Club movement, basically gleaning a lot of lessons on successful investing from all of you and attempting to collate all of that and put those tools following the teachings of George Nicholson and the Modern Investment Club movement and putting it at your fingertips. We believe that simpler is better. I think you're going to see a lot of simplicity in the stuff we talk about tonight, and that's kind of our mission, to kind of back up a little bit and simplify it, especially for the people that are relatively new. At Manifest, the return forecast, which Ken will be talking about, is the most important, but quality is also very important. We want high quality companies with the right type of returns. In other words, better companies at better prices. So again, they've been doing this for a long time. So we're here to show you that kind of stuff. And we do fundamentally believe that anyone can do this, and the opportunity, there are no guarantees in the realm of investing, but the opportunity to achieve some really cool results is out there. And there's a little more information there if you want to come back to it about Manifest. So with that, Ken, you got your teaching voice revved up and ready to go?
I'm all ready to go, Mark. And
Okay.
as a teacher by trade, I understand that we have to repeat things a number of times before our beginners finally understand them. I want you to think back to when you learned to read and understand that we didn't hand you a 500-page manual and say, have a report ready for us in the next week. We handed you materials that you could understand that use simple vocabulary. We did everything we could to explain that vocabulary, and we tried to leave you with some things that would stick in your mind for a long, long time. How many of you still have 30 days has September, April, June, and November, when short February's done? All the rest have 31. That's been in my mind for years and years and years, and it came from Mrs. Boyd, my first grade teacher. So I want you to all join together with the Mid-Michigan chapter. We've been singing since 1997 the song Up Straight and Parallel. And we ask people to sing it even when they don't even really understand what it means to begin with. So sing it to yourself and keep it in mind as we begin to move through some very simple lessons. This is going to be unlike any other introduction to better investing methods that you've ever seen before. Next slide. Everything begins with sales, folks, and that's an easy word. Most of us understand what it means to sell something. A synonym for sales is revenue. And as people become more sophisticated in the world of business or in the world of investing, they like to come up with synonyms to mystify the novice. And that's true of any activity that humans engage in. Talk to a people on a football team, and they'll talk in a language that most of us could never, ever understand. Walk into the laboratory when there's a group of doctors discussing disease, and again, the vocabulary would stymie most of us. What we need to do is get over some of the vocabulary so we can understand the simple qualities that can make you a better investor. One of the things we want to impress upon you is that we're looking for companies with some history. And we want that history of selling either a product like a widget or an automobile, or selling a service like a piece of software, or selling something like a plumber would sell, a service to come out and fix your sink. We're looking for companies where the sales or the revenue is increasing consistently over that history. And that's the important word, consistent growth in sales. Faster growing companies tend to grow sales at more than 12% annually. That's an easy concept to understand. As these companies get a little bit larger and become moderately growing companies, that sales growth will fall on average to the 7 to 12% range. And as these companies continue to grow and become slower growing companies, those sales growth numbers will fall even further to something less than 7%. These are averages. There's exception to all the rules, and that's why we don't call them large companies or medium-sized companies or small companies, but we call them faster growing, moderately growing, and slower growing. Next slide, Mark.
Okay, I just wanted to make one quick fun fact tidbit here. somebody asked George Nicholson, the grandfather of the modern investment club movement, one time, where do you become less interested in a company when it comes to this first characteristic of sales? And he said, well, you know what? When it gets down to 3% or less, especially if it's declining, that's when I become less interested in a company, or I might even become concerned if it's one that I happen to hold. So that 3% number is one that he tossed around as a kind of a minimum. So 7 is not necessarily bad. 7, 6, 5. Just make sure you understand that. There are great companies growing at 7%.
And I guess it's time for me to say at the same time that we're on that slide, Mark,
Oh, I'll
that
go back to it.
it's very rare to find companies that will exceed sales growth of 20% for any significant amount of time.
True.
And when you find companies like that, you must keep in mind that they can't do that for a long period. If they can do it for 5 or 6 years even, that's exceptional. 20% is usually the outside limit, and somewhere around 15, 16, 17 is where our fastest growing companies are able to achieve those rates of sales growth for longer periods. But eventually, as the companies grow, the sales will decline. The sales growth percentage will decline. Here's our next slide now. Better investing suggests that you could call companies small if they have sales of less than $1 billion. You can call them medium-sized if they have sales in the 1 billion to 10 billion range. And you can call them large if they have sales in excess of 10 billion. The problem with using these numbers rather than the percentages on the last slide is that these numbers need to be revised on a fairly regular basis as we get inflation making things more expensive. I would say, for example, that a small company might today be somewhere up into the $1.5 or even $2 billion range in sales, and a large company might be somewhere into the 20 or even $25 billion sales before you consider it really large. We're going to spend some time with these concepts later. And right now, we just want you to sit back and relax and listen and think about the vocabulary we're talking about. We understand that sales can eventually be turned into something called profit. And again, profit is a word that most of us intuitively understand. It's the money you make whenever you're doing something that you're out to try to make money doing. We'll reflect this arithmetic on something that businesses call the income statement. And the top line, remember, it all begins with sales. So the top line on an income statement is sales. Next slide. To arrive at the amount of profit that a company makes, we're going to do some subtraction from the amount of money that comes in as revenue or as sales. First, we must understand that businesses talk about profit in many different ways. And their goal, again, is to be very clear, accountant to accountant, and to be a little bit opaque sometimes to the people that are trying to read the accounting reports. They talk sometimes about pre-tax profit or net profit, to name just a few variations on profit. But profit, no matter what the type, is something that's left from the company's total amount of money received, that's revenue, after you subtract expenses. Pre-tax profit, that's the amount left before you pay taxes. And net profit is what the company has left after you pay the taxes and certain other specified charges. I'm being a little bit vague at the moment. we're trying to keep the income statement real simple. Here's what it looks like. Next slide, Mark. It starts with the top line of sales and ends with the bottom line of profit. We're going to subtract expenses, and then we're going to subtract taxes. You can't avoid taxes, but the company doesn't have a lot of control over that tax number. So sometimes we like to look at the profit as pre-tax profit rather than as bottom line profit, because the pre-tax profit hasn't had the tax removed. The next vocabulary we're going to talk about is a share. And we're going to want to know how many shares are outstanding. A share is just a piece of the whole. And when you say that a company has X number of shares, you just mean that the whole has been divided into that many pieces. This is an imaginary company, excuse me, that you're looking at right here. So all of these numbers are imaginary, and the shares outstanding that I'm going to quote will be imaginary as well. Next slide. There's that income statement again up at the top corner. So what if we had that number of shares? It's an odd number. It usually is. And that's a fairly low number for numbers of shares. Many times companies will have shares in the millions of shares outstanding. One of the values that we need is earnings per share. Folks, that's a ratio, a fraction, and it's nothing more than total profit. In this case, it would be $120,500 divided by shares outstanding. It'd be that odd number that I wrote there at the beginning of the paragraph. Another name for bottom line profit is earnings, and sometimes the percentage of sales that converts to profit is called the margin. In this case, the margin would be the profit, that's 120,500, divided by the top line of 500,000 or $500,000, and this company would have margins of 24.1%. That's a pretty healthy margin, but we don't know if it's good or bad because we have nothing to compare it to. We don't even know what our imaginary company does. Next slide. Now that we know what earnings are, and now that we've calculated earnings per share, we can make a forecast. We're going to forecast the earnings 5 years into the future. I have seen future Better Investing members get frozen at this step in their learning process. And I'm asking you to keep it as simple as you possibly can. Let the experts at the beginning tell you what the earnings growth rate has been previously, and use that value to help you estimate future growth. There's so many sources for historical data. You can get that historical data in Value Line. You can find it in Morningstar. You can find it on the internet on Yahoo Finance or Zacks or the NASDAQ site. You can find historical data in all kinds of places. Let's say that our imaginary company grew earnings over the last 10 years at 8.5% per year. Let's say in the last 5 years, those earnings slowed just a bit. And the last 5 years, the earnings growth was 8.3%. I think it would be very reasonable for us to forecast earnings growth for the next 5 years, and that's our goal in this exercise, at 8%. You might think that 7.9 is a better number, and there might be some of you out there that would like to use 8.2. Your numbers would be just as reasonable as mine, but I think it would be unconscionable to suddenly decide earnings were going to grow at 20% when they've been growing at a little bit more than 8 for the last 10 years. And it would also be unconscionable to decide that earnings are going to only grow at 5% going forward when they've been growing at 8 for the last 5 years. I'm going to use 8, and I'm keeping it simple. I'm basing my ideas on what the experts are telling me. Next slide. Here I'm showing that growth. That $120,500, that was the earnings in 2023. So I'm growing those earnings 8% a year. The calculation is to multiply by 1.08. If you wanted to grow them 12% a year, you'd multiply by 1.12. I hope you see the pattern. If not, it's time to ask a question. When you do the calculation, and please, for goodness sake, use a calculator, you get 177,000 plus as the earnings 5 years from now. Next slide. Now we need a way to compare stock to stock to stock. Using stock price would be a terrible way to compare companies. Absolutely terrible. Because each company has a different number of shares, and just because its share is trading at $700 and another company's share is trading at $100 does not mean that the $100 price is cheaper than the $700 price. It would be like comparing cans of juice in the grocery store, where each can that you look at is full of apple juice, but they're all different sizes. The smart shopper would make a ratio. They would look at cents per ounce. Cents, the price of the juice can in pennies, divided by ounces. How many ounces in the can? And then you could compare the different cans as to the best bargain. Remember, lowest price does not necessarily mean best juice. We're going to use another ratio to compare stocks. It's called the PE ratio, and it's current price divided by most recent 4 quarters of earnings, most recent fiscal year, or most recent 4 quarters of earnings. PE is a simple fraction, and it will allow us to compare stocks. I will tell you it's not a perfect tool, however, but it's a good tool for beginners to help them get a handle on stocks that are more expensive than other stocks. Next slide. Now it's time to memorize and internalize a formula. I haven't asked you to memorize any formulas up to this point, just a little bit of simple arithmetic and some ratios and vocabulary. Here's a formula that, if you'll keep it in your mind, will help you as you begin to put together your own analysis for any particular stock. A PE value at a certain time times the earnings at that same time will give you a price at that time. If I take the PE value today for a stock, and I can find that on the internet, and multiply it by its last 4 quarters of earnings, and I can find that on the internet, I should have the price of the stock on that particular day. Again, keep it simple. Look for data to help you in your forecast. Value Line, for example, gives us average PE values over long periods of time. The report also forecasts what they think the average PE will be 3 to 5 years into the future. Manifest Investing gives us a 5-year in the future average PE value based on data coming from YCharts, another data source. Use the experts. Don't try to recreate something as a novice. Next slide. We've consulted Value Line and we found the Value Line sheet for our imaginary company, and they're suggesting that the PE, the average PE, will be 18, 3 to 5 years in the future. So use it. The PE 3 to 5 years in the future is 18. The earnings 5 years in the future at my growth rate that I set is 20.6 cents or 0.206 pennies. And that gives me a price for this stock 5 years in the future of $3.71. The formula is simple. A PE times an earnings gives you a price. I'm going to repeat that formula 100 times as you go through these various classes in the series with us, and eventually it will become second nature to you to use this formula to develop a price. Next slide. The stock is currently trading at $2.36. I looked that up on the internet. All I have to do now is use a business calculator or a computer or ask one of my really smart, nerdy friends to do a little bit of algebra and tell me what the annualized return would be to go from $2.36 to $3.71 in a 5-year period. Well, I know how to do the algebra. I have a degree in mathematics and I taught math and calculus for years. The annualized return, which you can do on a simple calculator, is 9.5%. That's pretty good return, pretty decent return. Here's another number you should remind yourself of. The average stock over long periods of time has returned about 10%, give or take 0.5%. So this stock is looking to be right along with the average stock. Might it fit in my portfolio? That's a discussion for another time. But I have one of the most important numbers that I can seize upon. It's the potential annualized return, and I'm pretty comfortable with where it came out. Are you still singing Up Straight and Parallel? Well, I have another song for you to sing and to keep in your mind as we continue in this series. This is the 3rd or 4th time you've seen it and heard it. We introduced it in the last class, and the song is Earnings Follow Sales, and stock price eventually follows earnings. It's not lockstep. It's not perfect. It doesn't happen one after the other in perfect harmony It sounds like a children's choir where there's some dissonance and occasionally somebody goes off the track. But the chorus comes out loud and clear, and it's the basis of all that Better Investing believes in. A stock must earn to sell, and in order to earn and have a stock price that's going to appreciate, it must sell. Earnings follow sales, and stock price follows earnings. Boy, I didn't even bring up the stock selection guide. I didn't show you any graphs or anything else. And already you know more than an awful lot of the folks in an awful lot of the clubs that are still struggling trying to understand what an SSG is there for. It's not there to fill in, folks. It's there to come up with a return number, which you can then ponder about whether that number is big enough to be included in your portfolio. Next slide, please. Thank you. I'm going to turn it over to Mark right now because this is really interesting.
All right. Well, I wasn't expecting a Motown review tonight with all this singing, but good stuff, Ken. Yeah, I just wanted to take a moment and again commiserate with the people in the crowd that may be relatively new to this stuff. Just want to reinforce some of the stuff. We keep talking about things like business models and all that kind of stuff. And I'm going to lean on Denzel. Ken already mentioned him earlier tonight. In one of his movies, he's famous for saying, "Explain it to me like I was a fifth grader." And I think that's important advice for everybody. We also have talked uh, a little bit tonight about some of the traditional stock selection guide training. This method, this framework. And I can remember back in the days when we basically used thick crayons. In fact, I was infamous for perhaps tossing a crayon or two around the room for somebody who was trying to get too precise. I think, Ken, you've also been guilty of that in some of your sessions. Yeah, some people get carried away with forecasting and this illusion of precision. So, so this is a little bit of back to school. One of the things that I am going to point out to anybody out in the audience that may be swimming a little bit at this point, our advice is to be a sponge. Just keep soaking it up and basically seeking answers to anything that you don't understand. I tell the story of a dear friend of mine who got started in investing. She was a teacher, but she had no investing experience. She wasn't that strong in math. And basically, what she did is she kept an index card. And anytime she heard a jargon or a phrase or whatever and did not understand what it meant, she would write it down on the card. And then she would ask her club partners, explain this to me. And she would keep asking until she understood it, or perhaps look it up on the internet or read it in a book, whatever source works for you. And she would just cross things off as she learned, what do these things mean? And every year at the national convention, she would walk up to me and hand me the cards with all the jargon crossed off on it. And it was pretty cool. She went on to write a column for beginners on investing in Better Investing magazine, the work of Nancy Isaacs. Really good stuff. And so Ken's been
And that
talking
column
about,
was entitled Simply Stated. It was a wonderful, wonderful column.
yeah, again, this notion of keeping it simple. And, again, we're talking about companies like Apple and the business model on the upper right. That's a picture of the stuff that Ken was talking about only over a period of years. Now, again, this stuff is not, it can be intimidating. You don't want to get too carried away with it. The 7.9s and 8.2 Ken was talking about, the 8% is just fine for me, and it should be for most people. And here's another reminder. Look, just read down that list. These are some very smart people making some pretty weird predictions. I love the one from IBM. There's a world market for maybe 5 computers. Of course, the computer.
Mark, we We
All
have
right.
somebody in the audience that is giving you an assignment, Mark.
Okay.
Okay, they're asking you to check your source on the third quote because they think that it's an Irving Fisher quote.
Oh, okay. Maybe I have to do some proofreading and checking. Irving Fisher could be.
Wikipedia agrees.
Wikipedia agrees that it's Irving Fisher. Okay.
Correct.
All right. I will take care of that later. Um, the last two quotes say an awful lot also. Things have changed quite a bit. A lot of this stuff was very hard to foresee coming. I was watching a special this afternoon on the space program back in the 1970s and 80s, where the computers that they had were less capable than what we carry around in our pockets these days. So yeah, the world is a changing place. The thing to take away from this is you don't have to be afraid to build a forecast, and it's okay if you get some of them wrong. Everybody gets forecasts wrong. Okay. So here's another way. I just wanted to take some of the concepts that Ken has talked about and put them in what I think is probably one of the more powerful uh, things that the Better Investing Modern Investment Club movement has done, and that is to rescue people who are afraid of math and numbers and allow them to operate in a visual spectrum. Um, uh, we entitled this piece "Where Imagination Meets Vision," and it comes from a session that Ken and I gave down in St. Louis. The name of the presentation was Two Guys Talk Stock. And you'll notice that the St. Louis Dispatch photographer kind of forgot about me and left me out of the picture. So it's not that I'm bitter and that, someday I'm going to actually stop bringing this up, but I have been bringing this up now for what, 13 years, Ken?
About, yeah.
But what we want to point out is we put on a presentation where we're putting some of these graphics, these visualizations up on the wall in this classroom setting, and the audience is literally sitting there going, ooh, ah, just like at a Fourth of July fireworks celebration. And the article that is referenced there, the link is a public link down at the bottom, actually goes into a presentation where we talk about this notion of imagination and building that into a vision for what you expect from your companies. And here's a quote from Pulitzer that basically puts it in what I think is an appropriate context. We do like to keep things brief. George Nicholson did such a wonderful thing when he basically identified very few things that are really, really important and keep it brief. The sales, how fast are they going to grow? What is the profitability going to be? And as Ken just covered, that thing called the PE ratio. Appreciate it. And some people, it works better in a picturesque fashion. And the guide itself is also referenced there. So here's a look at what a company like Ken was just talking about would look like over time. We call this a business model analysis if we're dropping jargon. But what you're literally looking at is a historical, series of results for this particular company. The sales shown in green here over a period of years, and there's nothing terribly exotic about the red dotted line. That's just simply a trend line drawn by the computer through those numbers. Now, Ken came up with a growth rate for his company of about 8%. This one is also 7 or 8%. You could argue over 7 or 8, but it's right in that range. So that's the type of company you're looking at here. And then he also talked about dropping down and figuring out the earnings per share. This is the top line for any business. Ken has already mentioned it's what really does stir the drink. You want to make sure you have a good understanding of what the top line is doing. And then as Ken explained, the difference between this trend line and down here is the expenses. And there's actually a ratio we'll talk about for going between the top line sales or revenues and the bottom line profits. Now, the other thing that we've mentioned several times is notice that these are price bars. They are the low and the high for a 52-week period in all these cases. The ones on the left are all historical prices. The ones out here are value line estimates up here. Notice that as this company is chugging along, the prices are basically following on a similar flight pattern to the earnings results. Notice that when the earnings ticked up here, this little indentation up or step change up, notice that there was a pretty good move in that particular year. And then if things slow down, like you see over here, notice what you see up here. So again, you can go ahead and sing it if you want to do the Motown thing, but that price is going to follow earnings eventually for a company like that. So continuing in this theme of what we were putting on the wall for Mr. Carson of the St. Louis Post-Dispatch, he was in the audience. This one would have gotten an pretty interesting looking chart. Again, up, straight, and parallel. You can see that the distance between the revenue or sales results is pretty constant. It's definitely up, straight, and parallel. And this particular company is a community favorite. The name of the company is Jack Henry. The ticker symbol is JKHY. And again, it's in many of the portfolios of members of this community. And one of the more consistent, we would refer to this as a core company because it has been so consistent over the years. Do you own Jack Henry, Ken?
My wife owns Jack Henry in her IRA, and she's owned it for probably maybe 18 years, maybe even more than that.
This is an example of a pretty visual analysis. Call it a business model, call it whatever you want, but we like to ride along on journeys like this one. Okay? Here's one that's not so pretty. Again, this is about as far from up, straight, and parallel as you can get. What you're seeing here is a company that had fairly decent sales going up into this time frame, and then something happened that wasn't good. Sales actually decreased, and you can make a case that the trend has been decreasing for some time. Notice that for some reason this analyst thinks that they're going to perhaps recover out in that 3 to 5 year time frame. That is the value line analyst. Look what happened to the stock price. Well, let's go down to the earnings first. The earnings, now it's kind of tough to see because this is such a dramatic story, but it had actually been behaving fairly well. Actually had a pretty nice bump up in 2020. When that happened, just like we showed with the other company, this happened to the stock price. And then some of you are probably already guessing what type of company this might be. They actually went into a period where their profits, their earnings went negative. So this is one that you might giggle at a little bit or be concerned for. The earnings went negative. The stock price followed it down. The name of this company is Emergent Biosolutions. This is one that I've actually picked in some of our stock panel discussions, hoping for a turnaround. They actually are a company that messed up when it came to COVID vaccines, and they committed some operating errors and had some real functional problems. The problems were so severe that their sales went down and their profits or earnings turned negative, and it's quite an ugly picture. So Ken, have you forgiven me yet for picking that one?
Oh, sure.
It's a tough one. It's a tough one. Okay, here's another one. This one actually is a restaurant stock that was a real Wall Street darling a couple of years ago, and this one you are permitted to chortle. You don't have to ooh or ah. You can chortle. You wouldn't honk your horn at this one. Earnings have only been positive once, and this is a company in some level of distress. It's certainly early in the game for this company. There is no magic to this 10-year period other than when Nicholson designed the basis for doing this type of analysis, he wanted to include enough time to demonstrate a track record. In most cases back in that time in the middle of the last century, you would have had a couple of economic recessions during that 10-year period. We refer to a recession as something which tests the mettle of these companies. And that's why the 10-year period is there, to basically establish a trend, to establish consistency. And this is not consistent. This is something else. Okay. Any questions or comments on that, Ken?
I'll tell you that we do a stock panel at the convention each year. Mark's on the panel, I'm on the panel, and there's 4 or 5 other pretty good stock pickers on the panel. And we've actually had people present stocks on the panel with no blue line at all, no earnings line of any kind. And then they try to convince us that it's a good, solid growth company. And it just drives our audiences to hysterics. They love it from the fact that it's violating every single rule that we hold dear. So, do you know the name of this restaurant, Mark?
I will seem to recall it's like Burger Fi or something. I
Okay.
didn't grab the name. I'll tell you what I went looking for. I basically went looking for the company that had the lowest core score at Manifest Investing.
All
And
right.
this was among those. Now, core score, Ken wants us to explain, when we talk about a core company, and usually that's going to be a company with a track record, with all the stuff we've talked about here tonight that is desirable, but we're basically looking for this. Consistency over time. Again, this is a company probably growing at about 10%. So you want those consistency of results. You want a strong balance sheet, good financial strength, and other things that we're not covering here tonight, other than to say you basically want this type of picture. Up, straight, and parallel and core, I would argue, are kind of synonyms. Fair enough, sir?
I think so.
Okay, so with that, we'll just close with a quick look at Grainger. Again, inspired by Tool Time. Same type of situation. You can do the visual look for yourself. These guys were struggling a little bit in the mid part of the last decade. Still going strong, but they were having a little bit of operational difficulty. They did solve it. You can see that they came out and the earnings bumped up. You can see that here. There's actually pretty good improvement here in earnings. So again, we see this type of price action eventually. It's not always immediate, but once a company has basically laid out a plan and delivered on that plan, this type of thing will happen. And pretty good picture from left to right. Definitely qualifies as up, straight, and parallel for the most part, and could be considered a core holding in many circumstances. So again, Ken talked a little bit about some of the other stuff that we really do care about. We really care an awful lot about this notion of the conversion of sales into profits and how much you dropped down. So I thought I'd spend just a moment talking about that, because you can either look at this picture or you can look at the operating characteristic, which he touched on. We'll come back to this in a second. This notion of margin, net margin, or the bottom line of any company's performance. And in this case for Grainger, what we're showing you here, thanks to Value Line, is a picture of their net profit margin, just like Ken laid it out. That's the bottom line profitability divided by the sales, that third line divided by the one up above, basically generating the net profit margin over time. So you can actually visualize, in addition to looking at it this way, you're actually seeing the percent net margin over time. You can see that period of challenge here. And then you can also see that whatever they did, and you can dig in and figure out what they did with respect to inventory and supply chain stuff and all that kind of thing, they seem to have stabilized at a very healthy profitability. Again, if I'm talking about what would I expect from this company going forward in the future, I don't need 10.1 or 9.8. It's 10%. Keeping things simple. So again, a source like Value Line for a company like Grainger will provide this type of data, and you can take a look at the situation. And you're going to see a company growing in upper single digits, and good Value Line is an excellent source of this type of information. So with that, Ken, anything you'd like to add or reinforce?
Well, we're getting a question about calculating percentage growth from one year to another year when there's a gap in between. And I indicated that you could get that information from a business calculator. You can also just Google calculating growth, calculating annual growth between 2 years. And if you Google that, there's all kinds of tools right on the internet that will let you fill in the first year and the last year, and then let you fill in how many years are between them, or the interest that you're going to be charged on every single year, the growth that you're going to expect. Anyway, there's all kinds of things that you can do. You don't need a degree in mathematics. You don't need to use algebra. You can do the growth numbers on a simple Excel spreadsheet. Make ample use, folks, of the help button when you're on your Excel spreadsheet, and ask Excel how to do it. And they will tell you in no uncertain terms, with lots of examples, how to do growth from one year to another when you know a beginning value and an ending value. Excel spreadsheets are kind of like a magic wand. And folks, we don't teach, even in high schools anymore, how to do a lot of these very exotic calculations. If you're old like me, you still have logarithm in your vocabulary, but we don't use logarithms or slide rules. We don't even use radicals to any great degree anymore. We use Excel spreadsheets, we use Google, and we use any tool that will make our life easier as far as mathematics is concerned. So for those of you that are concerned, go to the internet, go to an Excel spreadsheet, make ample use of the search and help, and you'll get your answer that you're looking for, okay?
Yeah, one of the things that you might want to think about here is something that I've done in order to do a fairly coarse calculation. For a company that is this consistent, you're looking at this type of a picture, a lot of consistency here. Most of those dots hit that trend line. By the way, the number you're looking for is the slope of that line, but that's not for beginners here tonight. But what you can do is take this number right here, 17 billion, 17.5 billion, or 17,500 million. You just take the 17,500, count back 10 years. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Here's your first number. So you basically use any type of calculator which has the starting number, the current number of 9965. This is the number in the future, and n equals 10. And you will get about a 7% growth rate for this company. And that's going to be the number reflected over this time frame. So it's pretty quick one. Now, some of the stuff you want to watch for, again, this is maybe a little bit beyond the scope, but you want to watch for changes in management or changes in the structure of the company. A lot of times if a company does a major acquisition, which can jumble up these numbers down here, a value line will actually draw a solid line at that point. And so you can actually see where there's an inflection. In that case, you might want to stop here and calculate that number. So you want to watch for those changes in basically the company itself over time. But this one certainly doesn't apply to that situation.
I'm getting all kinds of comments from experts in the audience, and I appreciate your comments. I understand that we can point people to answers to all of these types of questions, but the purpose of a class like this is to keep everything on a very simple level. Folks, if you can't do the calculation tonight, that's okay. It's not important, because the goal of tonight's class is not to get you to do a full stock analysis. The goal is to familiarize you with vocabulary and with a few very simple calculations. Stick with us for the class tomorrow. Stick with us in the spring when we do more in this particular series. We're going to come back with more classes in April again, expanding this Just Beginning series, and we hope to have you come along. Ask questions of experts in your own clubs, because 9 times out of 10, there's somebody sitting in your club meeting that knows the answer and is just not going to be willing to enter into the fray to give you an explanation unless you kind of force the issue. Ask questions. There are no terrible questions for you to ask, and eventually we're going to get you to the place where you can learn to read a stock selection guide and then ultimately prepare a stock selection guide. I want to give you a heads up that on January 11th, Better Investing is presenting a stock up called Let's Be Reasonable. It's going to try to walk people through what they're looking for on a prepared stock selection guide and trying to make determinations whether the numbers that have been filled in by somebody else are reasonable or not. The subtext is you need to be able to read the analysis before you can ever hope to prepare the analysis. That's Stock Up from Better Investing on the 11th, and I know the material inside and out because I'll be presenting it. Mark, anything else?
No, I think we're pretty much covered. I mean, this is, we could point out that in the example that you cited, Ken, I mean, the numbers that you were talking about are right here. Future earnings and future PE ratio average for any company in the Value Line survey. So that's where you would find those two, just to start doing some tinkering around to make that comparison.
Absolutely.
Okay.
Absolutely.
So with that, tomorrow night, we're going to spend some time talking about where do we find stocks to study, searching for these characteristics that we know are at the core of the modern investment club movement, and how they drive us towards the types of companies that the community definitely favors.
If you haven't already registered for tomorrow's class, you can go to the Better Investing website. That's betterinvesting.org. You can look for the Mid-Michigan chapter if you're not from within our geographic area. And on our website, on the Better Investing website, you'll find a link to register. If you're a member of the Mid-Michigan chapter, and many of you are, right on the front page as you log into Better Investing, you'll find a current happenings box. And this is right there in the current happenings box. It's just a single click to registration for the class tomorrow. If you're a Manifest Investing subscriber, you can go to the Events tab and you can register at Manifest Investing from the Events tab. So it's easy to register, and we'll be with you at 8 o'clock tomorrow evening. And we plan on going to perhaps 9:15 tomorrow evening. So if you want the entire presentation, it's probably going to be closer to 65 or 70 minutes than it is to 50 or 55 minutes. Mark, anything to wind us up?
Yeah, I think that the audience should probably spend some time with Julie Andrews, and these are a few of my favorite screens.
Okay.
To prepare. Just kidding. What if we're going to go musical? We got to stay with the theme, I guess.
I guess so. All right.
Well, thanks everybody. We will close down the session and stick around and see if there's any questions.